Now that Meriwether Car Detailing has all of their financial statements prepared, the last step in their accounting cycle is to close all their temporary or nominal accounts, which are their revenues, expenses, and withdrawals. Our first closing entry we're going to have to record on March 31st is the entry to close revenues. Well, what do you do when you close something? You reduce its balance to zero. So if I go all the way back to our T accounts for our adjusted trial balance, we see service revenue had a credit balance of $16,000. If I put a debit for $16,000 in that T account, it reduces its balance down to zero. So in your closing entry to close revenues, you're going to have a debit to each and every revenue that your company has. Because we are a purely service company, we only have one revenue account, and it is service revenue. And the balance of service revenue, which I'll grab from our adjusted trial balance down here, was $16,000. To close these accounts, Meriwether is going to use the income summary method. So they're going to use this made-up transitional account to close their revenues and expenses to the company's retained earnings account. So we are going to, in this case, since we need a credit income summary, which doesn't have an account type, it's just transitional for that same amount, $16,000. And we closed revenues for the quarter. In our next closing entry on March 31st, we're going to close all of our expenses. Well, same thing. They are temporary accounts. To close them, we need to reduce their balance to zero. And since all of our expense accounts have a debit balance, if we credit all of those accounts, it's going to reduce our book balance for all those accounts down to zero. So since those are all going to be credits, we know our journal entry is going to need a debit. And the debit is going to be to that same income summary account. We don't know for how much. We can close all of our accounts for our expenses. And the first one was insurance expense. We're going to have to close that guy. We're going to have to close supplies expense by crediting it, reducing the value of that expense account. We are going to have to close depreciation expense. We are going to have to close interest expense, reducing that account. We're going to have to close salaries and wages expense. We're going to have to close our bad debt expense. We are going to have to close our property tax expense. And lastly, we are going to have to close our income tax expense. In full disclosure, as I'm filling this out right now, I have the adjusted trial balance printed out in front of me, and I made sure that I typed all 8 of those expense accounts in the same order that they are appearing on our adjusted trial balance. So now, in my closing entries, I know I'm going to want to credit insurance expense for whatever its balance is, and its balance is $1,200. I'm going to want to close supplies expense, depreciation expense, interest expense, etc., all for those same amounts for whatever the respective balances are to reduce all of those accounts to zero. And I made sure that I entered them in the journal entry in the same exact order that they're displayed here, so I can do this. First, I'm going to hit enter. I'm going to bring over that $1,200 for insurance expense on the credit side, which will reduce it. And then I'm going to use the fill handle. And that's going to bring in all of the respective numbers listed on the trial balance for all of our expense accounts. Let's just check real fast to make sure everything looks good. $2,900 for supplies, $300 for depreciation, $100 for interest, so on and so forth. Go back here. It's the same number. So that would reduce all of these accounts down to zero. So now we have to reduce our income summary account. Or we have to at least debit our income summary account for whatever is going to make our debits equal our credits, because debits always equal credits in journal entries. And that's going to be $7,600. Does that number make sense? And it does, because if we go back to our income statement up here on the top, we see our total expenses were $7,600. Using the income summary method, your debit to income summary in the closing entry should always be for the same amount as your total expenses listed on your income statement. And in this journal entry, we closed expenses for the quarter. I have a T account set up here so we can find our current balance of income summary after our first two journal entries. But what did we do? In the first journal entry, we credited income summary for $16,000. In our second journal entry, we debited income summary for $7,600, which means the balance of this account is going to be on the credit side since our credit was bigger, and it is going to be $8,400. We have $8,400 in our income summary account, which we're going to close to retained earnings. Does that number line up with anything we've seen on a financial statement? It sure does. Net income. And on our statement of retained earnings, we took that net income and we added it to retained earnings. We did that already in the financial statements. This entry right here is just doing it in our journals. And since we are increasing our retained earnings, and retained earnings is an equity account, we know that retained earnings is going to be our credit because equity accounts increase on the credit side. We're going to debit income summary, and we are going to credit retained earnings, again increasing that equity account, for the balance of our income summary account, which is going to be $8,400. In doing so, putting a debit over here for $8,400 will reduce income summary to zero. Income summary is also temporary, so it has to get closed at the end of every period. And we closed income summary to retained earnings. We have one more closing entry, and this is not what it's supposed to say. We need the journal entry to close dividends to retained earnings. Dividends, when you're a corporation, are your company's withdrawal account. According to our adjusted trial balance, cash dividends has a balance of $1,400. We need to reduce that to zero, so how do we reduce an account with a $1,400 debit balance down to zero? We credit it for the same amount. So I go back to my closing entries right here, and that's going to tell me that my debit needs to be to retained earnings, reducing that equity account, because if we pay the dividends, we're not retaining those earnings. And we're going to credit cash dividends for that same amount. And retained earnings is going to be debited for whatever the balance of cash dividends was, and the balance of cash dividends was $1,400. We're going to credit cash dividends for that same $1,400, which would reduce its balance down to zero. We closed cash dividends to retained earnings. I use the income summary method frequently because I like to have all the different journal entries broke down. But it is entirely possible that instead of going through 4 separate journal entries for the closing process, you can actually do it in one really big compound entry. So as a bonus, I'm going to show you guys how you would do that. Close everything at once. What you do is you start by debiting all of your revenue accounts. We only had one. Again, it was service revenue. Our service revenue account is going to get debited just like it did in this top entry for $16,000. Leave a line blank. That's where retained earnings is eventually going to go after you've put in your revenues, but we don't know if it's going to be a debit or a credit yet, at least for this purpose. So let's skip down and start crediting all of our expense accounts that we had closed previously. I'm actually going to cheat right here and hit equals and then go up to all of these expenses that we have listed here. I'm going to click on the top one, and then when I fill handle, it's going to bring down all of those accounts. So we've got supplies expense, we've got depreciation expense, we've got interest expense and salaries and wages expense, we've got bad debt expense, we have property tax expense, and we have income tax expense. The same accounts that we closed up here. So you just credit all of your expense accounts. And lastly, we had one more temporary account that we credited during the closing process, and that guy's right there. He's cash dividends. So it's equals, and I'm going to go grab that cash dividends amount, bring it down here too. What were the amounts that we credited for? Well, for insurance expense, it was $1,200 we credited for. We credited supplies expense for $2,900, depreciation expense for $300, etc. I can use the fill handle one more time, and I'm just going to bring it down for all our different expenses. The same numbers we're crediting for were what we did when we were using the income summary method. Like all the same numbers, we're just making a journal entry that has this journal entry like sucked into it, at least for the credits. And then we got cash dividends, which we credited for $1,400. You would credit it for $1,400 if you're going to do it all at once. At this point in time, what are the sums of our debits and our credits? Well, we only got one debit, so we know that it's $16,000. What's the current sum of our credits? The current sum of our credits is $9,000. That is a difference of $7,000. We would need a debit over here for $7,000. And that debit is going to be, sorry, we're going to need a credit. Hold on, that didn't work out the way I wanted it to. We've got $16,000 worth of debits, just that guy. And then over here we have $9,000 worth of credits, which means we're going to need a credit for the difference of those two, which is $7,000. There we go. Put the cell formulas in right. And that credit is going to be to retained earnings. Does that $7,000 amount for retained earnings make sense? We're saying we increased our retained earnings by $7,000 during the period. Do we have a statement that justifies that? We absolutely do. Our statement of retained earnings says that we increased retained earnings by $7,000 during the period from the zero we started with to the $7,000 we ended with. So the amount that retained earnings gets debited or credited for is the change that you had in retained earnings during the period. You can close either way that you want to. It's not going to matter one bit if you use the income summary method, if you don't use the income summary method. It's really all about what all of your preferences. But you can, if you wish, make one gigantic entry that's going to record the fact that you close your temporary accounts to retained earnings. And with that being done, the last step in the process is to make sure that after all of these accounts are equal to zero, you still have debit and credit equality across your real or permanent account. So the last thing that Meriwether has to do is they have to make a post-closing trial balance. The only account types that will be on your post-closing trial balance are your asset accounts, your liability accounts, and your equity accounts. So let's bring these numbers over. The nice thing about this is you don't close any of these accounts. So what you had in your adjusted trial balance is going to be the same exact number that you have on your post-closing trial balance for all of your assets and liabilities and even your stock accounts. So let's go, and it equals, we're going to go back to our adjusted trial balance, and I'm just going to click on this 19,500, and then I'm going to go and I'm going to fill handle in all the way through our various assets to save myself some time. There we go. I don't want this slash right here, so I'm just going to click on it and hit delete. We carry down the $6,000 in AR, $5,100 in supplies, $3,600 in prepaid expenses, and $6,800 in equipment that we had from our adjusted trial balance. None of those amounts changed during the closing process. What about our liabilities? Well, we had all of these guys over here. These are all of our liability accounts and notes payable down here for $10,000. We had to bring all of those guys over. None of those changed during our closing process. So again, if I go back to my post-closing trial balance, I'm going to go to the credit side, starting with accumulated depreciation, and then grabbing my liabilities and grab all of these numbers. So I'll bring that over. You would just go and copy all of these. Again, to save time, I can just bring them in. We have $33.60 worth of accounts payable, $660 worth of salaries and wages payable, $100 worth of interest payable, $2,800 of unearned revenue, and $10,000 worth of notes payable. Our equity accounts, we have two. One of them is common stock. And common stock does not change in your closing process. You don't close your stock account because that is like ownership of your company. If you closed it, you would mean that no one owned any part of your company. That's just not the case. So we bring that $16,600 over. What is your retained earnings going to be? It's going to be whatever the last known balance of your retained earnings is, which, just like we did with our balance sheet, we're going to steal from the end of our statement of retained earnings, which is $7,000. And now I'm going to find the sum of all of my debits and come up with $41,000. And I'm going to find the sum of all of my credits and hope that that's $41,000 as well, so I can go through and close my books for the period. And I have a number that is slightly off here. I am missing $180 because of Airhead, and I forgot to put the $180 in for allowance for bad debts. So let me go grab that really fast. There we go. And now, because I used the formula, look, it corrected my mistake. We have $41,000 worth of debits and $41,000 worth of credits.